Hi there, ladies and gentlemen. It's James Marley here, co-founder at Livewire Markets, and today I'm joined by Angus Gluskie, Managing Director at Whitefield. I'm going to be talking about generating reliable returns on the ASX. We all love them. We all would love to get some reliable returns. Now, Whitefield has a quantitative system that it uses to build its diversified portfolio. Could you talk me through the process? Explain it.
Sure. Well, look, I guess the concept first came out for us in the early 2000s, where we were looking at the electronic data that was becoming available and the data infrastructure that people could utilise. And we thought they were going to both be vital ingredients in terms of running a successful process of investment management. So look, we set about building a quantitative infrastructure, meaning an infrastructure that allows us to ingest electronic data quickly and efficiently, and to then make sense of all the data that was becoming available in investment markets and be able to build or utilise that in the delivery of our strategy in the best way possible. So that was our initial thoughts that started the process. But it is worth recognising that when we do that exercise, we're still performing the fundamental task, or the task of fundamental stock analysis. We're just utilising data and quantitative tools to do the process efficiently, rigorously and consistently.
So you've talked there about the quantitative approach. Is that replacing fundamentals or day-to-day stock picking that many fund managers would be familiar with?
No. Essentially, we're very much looking at a number of the same characteristics, but we're just doing it with very consistent measures, lots of data in the background. It's an educated way of doing the same exercise.
Okay. And have you got some evidence or data to support that it adds value and it's a better way of doing it?
It's certainly been working for us, but interestingly, there have been some studies done overseas where they've tried to look at whether quant fund managers perform better or worse than non-quant managers. The studies actually show it's much of a muchness. And I think perhaps some of the flaws in doing that kind of exercise are failing to recognise that, look, within the quant space, you'll have better and poorer managers, and within the fundamental space, you'll have better and poorer managers. And equally, it's hard to work out which side of that equation people sit on. So, for example, we're using quantitative tools, but we're doing an exercise of fundamental analysis. So are we really a quant manager or are we a fundamental manager? I think thinking it through logically, probably the most important thing is that the manager is using tools which are suited to the delivery of the strategy and its objectives.
So Angus, in the introduction, I talked about generating reliable returns. Let's hear how you do it. Could you talk about the quant factors that you think are most important in getting those reliable returns?
Sure. It's worth thinking, of course, that a great part of the value add from a quant process is actually the process itself. You know, the consistency, the reliability of the measurement process, the usefulness of the data that goes in the back end. So the value add is as much the process as it is the particular factors or metrics that we're measuring.
The discipline.
Yeah. And equally, it's we're using thousands of metrics in terms of our process for assessing stocks. It's very hard to draw out any one individual metric and say that's more important than others. However, look, we do group our metrics together into broad factor groupings, and the factor groupings are quite logical. They're the groupings that relate back to how investors think about and interpret stocks anyway. So, for example, our major factor groupings are value. So we use lots of metrics to then assess both where value is and also how it might revert. We use a great number of metrics to assess the quality or robustness of a business. And also we're using metrics to assess how the earnings are likely to develop for a business going forward. So collectively, each of those things give us insight into pretty important elements as an investor. You know, at the end of the day, we're doing the same equation that all investors are. We're looking to buy businesses for reasonable prices where they have an ability to generate earnings over future years that are at least as good as the expectations baked into price, and ideally somewhat better.
Could I get you to bring that quality, value, earnings framework to life with an example?
Yeah, maybe a current example would be the Goodman Group. So, involved in industrial property. So our quality metrics suggest that Goodman, we rate Goodman quite highly on our quality metrics, suggesting that they've got a moderate to low debt load for the industry in which they operate, and equally that they're reasonably successful and well competitively positioned within that industry of industrial property. From an earnings perspective, they've done well through their developments over recent years, and the expectations are that in the near and medium term, they're likely to continue to be able to produce good earnings out of that development pipeline. But from a valuation perspective, people like the stock based on those fundamental elements, and it's expensive, and on a number of metrics. And so when we combine that together, it suggests to us that while the stock is expensive, it's somewhat justified, and it means it could form a reasonable investment, generating probably a mid-level rate of return for an investor.
Okay, so earnings relative to expectations, not about earnings continuing to increase over time. So you're willing to buy a cyclical stock that might have depressed earnings at one point in the cycle, but if they're better than expectations, you're happy to own it?
Yeah, it's a really important point, that one. So conditions, or one of the things that actually comes out of as you look through history and stock performance, is that it's not so much the information that's known today that determines the outcomes of that stock in future. It's the second derivative all the time. It's how a company's actually able to perform relative to those expectations, which are based on all the things we know today. So it's a reasonably fickle equation to judge, and it's why often it's quite handy to have a quant framework that's doing that process on a routine basis.
And Angus, what are some of the traps or mistakes that people need to be aware of, and could you maybe bring it to life with an example?
Yeah, look, I think investors often are too quick to think markets might be calamitous, and the reality is very calamitous markets are rare. Equally, one thing that history shows us is that markets, even while they will experience dips, larger or smaller, dips are always followed by recoveries, and sometimes those recoveries can occur very rapidly after the dip in the first place. So I think just understanding that markets are relatively resilient is a pretty important lesson for investors, and it certainly then suggests to us that patient long-term investing can be quite a handy way to navigate those kind of issues.
Okay, great. Well, ladies and gentlemen, I hope you enjoyed that episode of The Pitch with Angus Gluskie, Managing Director at Whitefield, one of the oldest listed investment companies on the ASX. Be sure to check out the other YouTube videos that are up for this series.